Hey guys, welcome to the third video of the Small Business Finance 101 series. I'm Mani Karthik, and in the previous videos, we talked about income statements and balance sheets. If you missed those videos, please go check them out using the links in the description below. Today, we'll be talking about cash flow statements. As explained in the previous videos, a cash flow statement is a financial statement that deals with the cash flowing in and out of your business. And in this video, you will learn what a cash flow statement is, how it looks, the components it holds, and why your small business needs it. Let's go. So, a cash flow statement is one of the three important financial documents of a company, and it shows the amount of cash and cash equivalents that flow in and out of your business. Now, when I say cash equivalents, what I mean is there are some short-term, highly liquid investments that you can easily convert to cash, like short-term government bonds, commercial paper, treasury bills, etc. A cash flow statement usually shows how well a company manages its cash that goes into the business or out of the business. Just like an income statement, a cash flow statement shows a company's financials over a period of time, but it only focuses on the cash aspect of the business. There are three aspects we will look into while studying the cash flow statement. The first is operational, the second is investment related, and the third is financing. Now, let's do a deep dive into the components of a cash flow statement. First, we look at cash flow from operations. Here we start with the net earnings. Remember profit after tax from the income statement? It is the same as that. This goes to the top of the document. One thing you need to remember is that to have a clear understanding of what is added or deducted from this net earning, you need to think about whether cash is going in or out. Only focus on the cash part of the transaction. Depreciation seems to be added here. Crazy, right? Well, if you look at it from a new perspective, it's not. So depreciation is deductible from taxes, right? What you lose in depreciation of any assets also saves you taxes, which in turn adds to your cash reserve. The next thing here is the decrease in accounts receivable. Again, because you get cash that you were supposed to receive by definition of accounts receivable, that is why accounts receivable is reduced. So this is also added to your cash. Increase in accounts payable and taxes payable are also added for the same reason that you get an influx of cash when your debt increases. Now, what's deducted from net earnings is an increase in inventory. Why? Because in order to buy new inventory, you need to pay cash. When you add all this, you get the net cash flow from operations. Now, let's look at the cash flow from investments. There are only two components here: capital expenditures and sale of assets. The capital investment are your long-term investments, and they are deducted because cash flows out of your business for purchasing those assets, and the sale of assets is, well, self-explanatory. When you add this, you get the total cash flow from investments. As you can see, this is negative. Again, before you panic, this is normal for every growing business anyways. A negative total cash flow from investments means that your company is investing heavily in long-term assets that will generate returns for years to come, which is a good sign. For a small business, cash flow from financing deals with owners' investments, owners' withdrawals, and debt raised. Owners' withdrawals are deducted, and the owner's investment and debt raised are added. The total here gives you your cash flow from financing. When you add cash flow from the three sources, operations, investing, and financing, you get total cash flow for the time period. Please note that cash from balance sheet at the start of a time period plus cash flow during the time period gives you cash flow for the balance sheet at the end of the time period. And that's it. That's how a cash flow statement works. About why it is used, the answer is simple. In both the previous financial statements, you could not see where your liquid cash was, only how much you had. And cash is a pretty important asset. So the cash flow statement tells you exactly where your cash and cash equivalent assets are coming from and going to, and thereby you can plan and use them wisely. That was it for today. We've covered how to write the three main financial statements, and in the next video, we will talk about how you can read them, interconnect them, analyze them, and make sense of it all. Give us a thumbs up if you like this video and subscribe to our channel to not miss out on the upcoming ones. Until next time.